Measurement fundamentals continued. Looking at financial accounting fundamentals, there are 4 assumptions that underlie accounting in general. First, that when we look at measuring, we identify and we measure an economic entity, and we trace those events, those transactions of that entity, and we keep them separate and distinct from all other accounting entities. Now, an economic entity does not necessarily refer to a legal entity, like a person or a corporation is a legal entity, but an individual, a person, could be an accounting or an economic entity if they plan to do business as a sole proprietorship or join with someone else in a partnership. So that's the first assumption. The second assumption is that when we measure for a fiscal period. In other words, we want to know how a business did for a certain time period. So we take the economic life of a business and we divide it into periods. Generally, those periods are a year. The third assumption is that we're dealing with a going concern. In other words, this business is in business not only this year, but next year and the following year. In other words, the life is indefinite. And this entity will continue in existence as long as it is around to carry out its objectives and commitments. So the going concern idea, and then we split that going concern periodicity into different fiscal periods to measure results. The last assumption is that there's a stable dollar. In other words, all events can be expressed in terms of some monetary unit, and this measurement unit stays relatively constant from period to period. And when we're measuring results, we're not measuring inflation, but how the business is doing. In addition, we have some measurement principles of cost or of value, and there are 4 of them. There's 4 basic ones. The first one is objectivity. That means when we measure something, the values are verifiable and reliable and can be documented in a systematic and reasonable manner. Revenue recognition, meaning that revenue is recognized when it is realized or realizable and earned. In a couple slides, we're going to find that there are 4 criteria that you can use for realized and realizable and earned. Matching, that expenses or efforts are recognized in the same period as the related revenues or benefits are recognized. A lot of times we'll talk about this as accrual-based because we're looking at our cost benefit or our efforts versus rewards of our business. Full disclosure is another one. Circumstances and events that make a difference to the financial statement users are contained in the financial statements and notes. In other words, if you would like to know about something, those financials should disclose it so that you can make good, informed decisions because you have the facts to make the judgments on. And finally, there are 2 constraints that you have to think about, and those constraints have to do with materiality, meaning that if you did know that piece of information, it's of little or no effect of knowing it on your user decisions, so it's immaterial. The second constraint, in other words, that you could deviate from those 4 measurement principles, is conservatism. Conservatism says, if in doubt, you always understate your assets, overstate your liabilities, tell them the bad news first, meaning accelerate your losses, and delay your gains. And you delay your gains because of legal liabilities.